All right, today we're going to talk about accounting for current liabilities. This is found in Chapter 9 of your textbook. To start with, let's talk about what a liability is. As they say here in your book, a liability is a probable future payment of assets or services that a company is presently obligated to make as a result of past transactions or events. So basically, something happens in the past, such as you sell merchandise to somebody, well, in this case you would be buying something from somebody, and because you purchased it and they delivered it to you, you have an obligation, a current obligation, a present obligation to pay for that. And the plan is you're not going to pay for it today, you're going to pay for it sometime in the future. Such as if you bought merchandise, then you may be given 30 days to pay it. So all three of these things have to be involved if you're going to refer to something as a liability. So it's money that you owe for something that has already taken place and that you're going to pay it in the future. All right. Now, things like salaries. Let's say you know that you have employees and they're going to be working for you for the whole year. But those aren't considered liabilities until the people have actually performed the work and you know how much it is that you owe them, and then they're going to get paid like in a couple days or next week or something like that. So just because you know that there's an expense coming up, it's not a liability until it has actually taken place, till the event has occurred or the services have been performed. That's important. Second thing about liabilities is that we record them as either current or long-term. Current means that it's going to be payable within a year, typically. There's some other ways of looking at that, but basically if it's going to be payable within a year, it's a current liability. And if it's going to be for more than a year, it's a long-term liability, which is what we see down here. Now, you may have a long-term liability that has a current portion to it. And this is what it's talking about here with Domino's. Domino's has long-term debt of, what is this, $1,451,000,000. But the current portion of that, which is due this year, within 1 year, is $835,000. So on your balance sheet, you would report $835,000 of this under current liabilities. The rest would be reported under long-term liabilities. So that's kind of the basics about what liabilities are. Now, sometimes there's some uncertainty in liabilities, meaning it could be one of these three things. You don't know exactly who you're going to be paying, you don't know when you're going to pay, and you don't know how much you're going to pay. Now, this may not be true, you may not have all three of these things true at the same time. But it is possible that one of these things can be true, and it makes it a little bit more difficult to know how to record it. Such as uncertainty in whom to pay. A company can create a liability with a known amount when it's issuing a note that is payable to its holder. So if you have a note payable, it's possible that the note could be transferred or sold to another person. So even though you issue it to one company, it may end up in the hands of another company by the time it comes due. And so in this case, you wouldn't necessarily know who you're going to write the check to when the time comes. But even so, you know it's a liability that you must pay, and so it is going to be recorded on your balance sheet. Same thing with uncertainty in when to pay. A legal services firm can accept fees in advance from a client who plans to use the firm's services in the future. This would mean that that legal firm has a liability that it will be settling by providing its services at an unknown future date. So this is why the legal firm is not sure when they're going to pay, meaning when are they going to provide those services. But even so, the legal firm has to put that on their balance sheet to show that they have this obligation that must be taken care of. And uncertainty in how much to pay. You may be aware of an obligation that you have, but you don't know exactly how much it's going to cost you to settle it. And they give an example here of a company using electrical power is only billed when the meter's been read. but you have incurred the cost. You've already used the electric power. You do owe the money, you just don't know exactly how much it is. So when you're getting ready to do your financial statements, you often have to estimate the amount of that liability and include it on your balance sheet. So that's kind of the definitions about liabilities. Let's go ahead and move to getting a little more specific here. Since most of our liabilities come out of situations that we know exactly who we're going to pay, when we're going to pay, how much we're going to pay, these are called known liabilities. And the most common examples of that are the ones that are listed here. Accounts payable, sales tax payable, unearned revenues, and short-term notes payable. Let's talk about those things a little bit. An accounts payable takes place when you buy merchandise or supplies from somebody, and yet you don't have to pay for it immediately. You get to pay for it usually over a 30-day period. It's due in 30 days. So what you do in this case is you create an entry for debiting whatever it is that you purchased, such as inventory or supplies or whatever, and then the credit goes to accounts payable because you are increasing accounts payable. This is money you owe. You're increasing your liability. Same thing is true with sales tax payable. If you sell merchandise retail, then you are required by law to collect sales tax. But that sales tax is not your money. It's owed to the government, generally the state government. So when they give an example here of Home Depot, and they reported sales tax payable of $391 million in their most recent annual report. But as an example of a specific sale, if Home Depot sells material on August 31st for $6,000 and it's subject to a 5% sales tax, then this is how they would record that. They don't just bring in $6,000, they bring in $6,300 because 5% of $6,000 is another $300. So they actually take in $6,300 in cash. $6,000 of that is the sale. So they credit the revenue account called sales, but they also now are holding on to $300 that they must submit to the federal government or the state government. And in this case, it goes into a sales tax payable account because they haven't paid it yet. They owe it, so they have to increase the liability account, and this account will collect sales tax until it comes time to pay it. When it does come time to pay it, you would then debit sales tax payable, which is what it says here, and credit cash because you're going to be sending them money. Now, sales tax payable is not an expense because it's not coming out of your profit. This is money you collected from the customers. You're just holding it until it comes time to deliver it to the federal or to the state government. All right, another example of a current liability is unearned revenues. Unearned revenues are amounts received in advance from customers for future products or services. An example are advanced ticket sales. If you have somebody they give an example here of deferred revenues from ticket sales of $5 million in tickets for 8 concerts. So they received $5 million for tickets, but these concerts have not taken place yet. So they haven't really earned that money yet. So an account called unearned ticket revenue is a liability account, not a revenue account yet because they haven't actually earned the money. It's a liability account. They owe this, meaning that they owe the services to actually be able to hold on to this cash. So the unearned ticket revenue is credited for $5 million. Now, if all the concerts take place as they were supposed to, now this money is earned. So they can transfer it. Well, they give an example here of one concert that was worth $625,000. So you can transfer the $625,000 out of unearned ticket revenue into ticket revenue. And the way we do that is by debiting or decreasing the unearned ticket revenue account and then increasing the revenue account called ticket revenue by crediting it for $625,000. So they just explain that here. Unearned ticket revenue is an unearned revenue account and is reported as a current liability. And then some other unearned revenues would be airline ticket sales, because until you actually take that flight, that company has not truly earned that money yet. Magazine subscriptions, because they generally last for a year or longer. And then other things like construction projects, hotel reservations, and custom orders. You can read this part here about various reward programs and how they might record those things on your own. Okay, short-term notes payable, another very common current liability. And this is when there's a written promise to pay a specific amount of money on a particular date, but within 1 year. That's what makes it a short-term note payable. If you're going to be paying it over 1 year, if it's a 5-year note or 10-year note, then it would be a long-term note payable. It's a promissory note, which also means it's negotiable, meaning it can be transferred from one party to another. So you may borrow from one company or bank or person, but if they end up selling that note to somebody else, you'll end up owing the money to the other person. Most of the time, a note payable has interest that's involved in it. And so when you're given, or when you give a promissory note to somebody, it talks about the amount that you owe, the interest that's going to be charged, and the date by which it has to be paid. Now, often these notes are created because a person has purchased merchandise from a company and was given 30 days to pay it, possibly, but at the end of that 30-day period, they're not able to pay it. And so they transfer that amount from an accounts payable to a notes payable. And the biggest difference there is that under accounts payable, there's generally no interest being charged. Under a note, they're able to charge you interest. And so they're willing to extend you a longer period of time to pay because you're going to be paying them interest as well. So they give an example here of a company that on August 23rd, they ask if they can extend their past due $600 account payable to McGraw. McGraw agrees that if they pay $100 cash up front, they'll give them 60 days to pay the other $500, but they're going to charge them 12% interest. So this is the way Brady would record that transaction. They can take the accounts payable off their books, which they do by debiting it, because that's how we decrease accounts payable. They would then credit cash because they're giving them $100. But the other $500 is going to be a credit to notes payable, because now it's not an accounts payable, it's a notes payable. Still a current liability like accounts payable is, but now it's moving from accounts payable to notes payable. So they owe $500, but they also put in here that it's a 60-day, 12% note. So that's what it explains here. The form of debt has been changed from an account payable to a note payable. McGraw prefers the note payable because now they're earning interest. So when that note comes due and Brady pays it, hopefully, they're going to give them both the $500 but also the amount of interest that's owed them. And in this case, the interest is $10, which is calculated by taking the $500 times 12% times the 60 days. So it's only $10 in interest to be able to extend this over a 60-day period. Here's the entry. You're going to get rid of the notes payable by debiting it. That reduces it. You have $10 in interest expense, and we increase expenses by debiting them. And then we're paying with cash, so the credit goes to cash. That reduces the amount of cash you have on hand. Now, that's when you're dealing with a company, but we also have the same situation if we're borrowing money from a bank. And with a bank, you generally sign a promissory note, and this is a very simple one. They're giving an example of somebody who borrows $2,000, so that's your face value. This is the date that you're borrowing it. And you're promising that 60 days after this date, you're going to pay the $2,000 plus interest at the annual rate of 12%. So, if you're the one borrowing, this is how you would record it. On September 30th, you got cash of $2,000 because you borrowed it, they gave you cash, but you owe $2,000, and that goes in notes payable. So you explain by putting a note here that you borrowed $2,000 cash with a 60-day 12% $2,000 note. Now, when you pay this, you're going to get rid of the notes payable by debiting it, but you also have to record the interest expense, and you calculate that by taking the principal times the interest times the number of days that you have it. That's $40. So the total amount that you pay back is $2,040, and that's going to be a credit to cash. The only caveat here is that often you'll borrow money and it falls, the due date falls after the end of the accounting period. When that happens, you have to record the amount of interest that has been accrued up to the end of the accounting period. So because of the expense recognition or the matching principle, it requires us to record the accrued but unpaid interest on the note. So if you borrowed this money instead of on September 30th, you borrowed it on December 16th, and your fiscal year ends on December 31st, we need to record that interest expense that has been accrued between December 16th and December 31st. So that's 15 days. So 1/4 of that interest needs to be recorded in this year, not next year. And this is how you would do that. You would debit interest expense, but the credit doesn't go to cash because you're not paying it yet. The credit goes to an account called interest payable. Now, the next year, when you actually pay it off, you're going to debit interest expense, but this time for only $30 because you've already debited it for $10 up here. Then you debit interest payable for $10 because that gets rid of this amount because you credited here. Now you're going to debit here to cancel that out. The debit goes to notes payable for $2,000, which gets rid of what you had credited up here. And then you're still paying the same amount of cash, $2,040. And these three add up to this number. So this would be how you would handle it if your accounting period ended in the middle of the note period. Now, one of the most common forms of short-term liability for almost every company is the payroll liability. Being an employer, you have several expenses that occur because of having employees, and it can be the most significant part of your expenses as a company is paying people for wages, benefits, and other things that are involved. So, let's talk about those things. Employee payroll deductions. Most of you probably work for somebody and you get a paycheck every week, and if they're doing things the way they're supposed to do things, they will be taking out of your paycheck the amount that has to be submitted to the government for taxes. So, gross pay is the total amount that you make. So if you work 40 hours a week and make $10 an hour, your gross pay is $400. But that's not what you get in your paycheck. So the net pay, or the take-home pay, is your gross pay subtracting all the deductions. And the most common deductions are income taxes, federal income tax and state income tax. Now here in Florida we have no state income tax, but most states in the country do have a state income tax. And then Social Security taxes. There may also be deductions from your check for your health insurance, for a pension plan, for union dues if you happen to be at a company that has a union. So all of these things can also be deducted before you get your paycheck, before you get that net pay. This shows an example of those things that might be subtracted. Here's your gross pay up here. You separate everything out here, and then this is what you get after it's all done. So, employee FICA taxes. FICA stands for Federal Insurance Contributions Act. This is your Social Security and Medicare tax that are taken out of your check. Social Security currently is 6.2%, and Medicare is 1.45%. Now there is a limit to that. I don't know if it's the same as it is in your book here because this was in 2012, but somewhere around $110,000. If you make over that, they will stop taking out Social Security and Medicare. But on the first $110,000 you make, you're going to lose 6.2% to Social Security and 1.45% to Medicare. And then the other major withholding tax is your federal income tax here in the state of Florida. And then, like I said before, it could also be state income tax if you lived in a different state. Now, this is required by law for the employers to take it out of your check. You may say, well, why can't I keep it and just submit it at the end of the year? But it doesn't work that way. If an employer doesn't take it out of your check, they can be given very serious fines for not doing that. Now, the amount that's taken out of your check is based on tables that they have that include the amount of money that you're making and the number of exemptions that you claim. So that figure is going to be based on what you record when you fill out your W-4 when you start working for that company. Now, there may also be some voluntary deductions, like if you choose to be part of the health plan, then you may have a deduction for your health insurance. And there could be other things for like pension, union dues, those types of things. So employers have to keep track of all of this because they don't pay the federal government every single time they have a payroll. They're required to submit this to the government on some kind of schedule based on how much their payroll is. But every time there is a payroll, they have to make this accounting entry and keep track of how much it is that they owe the federal government and then submit it based on a schedule that the federal government requires or the state governments. So they give an example here of an employee who earns a salary of $2,000 per month. So this is how the employer would record it. The amount of expense is $2,000. But that $2,000 is going to go to different agencies and in this case to the employee. First, 6.2% of the $2,000, which is $124, is taken out. Then 1.45% is taken out for Medicare. And then $213 is taken out for income tax. And in this case, there's two other deductions, one for medical insurance and one for union dues. Once all of those things are taken out of the $2,000, what's left is what the employee gets of $1,524. Now, right here, it's going into salaries payable because they haven't paid it yet. Usually you calculate payroll and then a couple days later is when the actual payroll is paid. Now, when they do pay this employee, the debit down here would go to salaries payable to clear this out, and then a credit to cash, because obviously they're losing cash once they pay it. Now, the part that a lot of times people don't understand unless they've owned a company and had to do payroll is that on top of all of this up here that they withhold from your check, the employer is also responsible for additional payroll taxes. They have to pay an additional 6.2% and an additional 1.45% into Social Security and Medicare. They have to match what you pay. So on top of your $124 and $29, they have to take out of their own income 124 plus 29 and submit that to the federal government as well. In addition, they have two other things called unemployment taxes. One is for the federal government and one is for the state government. This is explained here, but just to say very generally, typically the amount that you pay for federal unemployment tax is only 0.8%, so a little bit less than 1%. But for your state unemployment tax, it's quite a bit higher. The base rate is 5.4% on the first $7,000 paid to each employee. So it's only on the first $7,000. So if an employee makes $50,000 in a year, the employer is only going to have to pay on the first $7,000. After that, there's no more state unemployment tax that's owed for that particular employee. Now, with states, this 5.4% can be reduced over time if you don't have a lot of turnover and you don't have a lot of people filing unemployment. So 5.4% is a lot, but it can get down pretty low if you have, if you're not in a business that has a lot of turnover or a lot of people filing for unemployment. Now, the way we record these taxes is this isn't coming out of anybody's paycheck, because this is coming out of your pocket as the business owner. And the way we record that is, let's say we have a person, the same $2,000 that the person gets paid. On that one individual, you have an additional $277 in payroll tax expense. 124 of that, as I already said before, is going to be your part of the Social Security. You're matching the same amount that the employee has to pay. You're also going to have $29 in Medicare tax. In this case, we're assuming a 5.4% state unemployment, which is $108, and then an additional $16, which is the 0.8% times 2,000. So this employer is incurring that he has to pay with his own dime an additional $277 for this one employee that made $2,000 this month. So this is the part that so many small business owners get upset about, that they're required to pay all of this for every one of their employees, obviously depending on how much they make, and this is what they say is really hurting them in terms of being successful as a business. But this right now is what is required of all business owners. Now, some of the liabilities we talked about, we mentioned that we divide them into current or long-term. But when you have a liability that actually extends over multiple periods, you may have some of that should be recorded as current, and the rest of it should be recorded as a long-term liability. So if you have a notes payable that is over a 3-year period as opposed to 60 days or 90 days or something like that, the current portion of that should be put into current liabilities. The rest of it would go into long-term liabilities on your balance sheet. And there's reasons why we do this. Some of it has to do with the ratios that we've talked about throughout the semester, and it allows investors who want to invest in your company as far as buying stock and things like that. By using these different ratios, they can make better decisions about whether or not your company is a good risk for them. So this explains how you might put some of it into current liability and some of it into long-term liability. This just mentions that most fraud involves payroll, so you can read that for yourself and just look at how some people go about defrauding either the federal government or their own companies. All right, let's turn to estimated liabilities. Some of the things that we need to record in our financial statements, we have to estimate because we don't know the exact amount that is going to be owed. And some common examples of that are employee benefits like pensions and health care and vacations, things that we don't know exactly what it's going to be because we don't know how many people are going to retire, we don't know what the health care costs are going to be, things like that. So you often have to estimate what you think that those costs are going to be based on your previous experiences over the years before, or on the amount that other industries have to pay. So what this particular employee does is, they're saying here, to illustrate, assume that an employer agrees to pay an amount for medical insurance equal to $8,000 and to contribute an additional $10,000 of the employee's $120,000 gross salary to a retirement program. So to record this, employee benefit expense is $20,000, so you're putting the whole $20,000 into an expense account, and then you're going to put $8,000 of it into a payable account, medical insurance payable, and then $12,000 into a retirement program payable account. But if this doesn't turn out to be the actual amount, if this changes for some reason, you'd have to go back and do an adjusting entry. But this at least gets it on the books that this is what you anticipate to be the expense for these employee benefits. Vacation benefits, you do the same kind of thing for. You put every week, you can read this paragraph for yourself, but there's going to be a difference between what you pay somebody and what paying them actually cost you in total, because if you're paying somebody for 52 weeks but they actually only work 50 weeks, then your total weekly expense is, they give an example here of somebody who makes $20,800 a year. Your total weekly expense is really $416, not the $400 that they make every week. And so the difference between those two things has to be recorded in some type of vacation expense account. So we would put the $16, this is on a weekly basis, charge 16 of it to expense, the other 16 to payable until the employee actually takes the vacation. Then when they take the vacation, if they take a vacation and it amounts to $200, then they would debit the payable account for $200 and credit cash for the $200. And then there's also bonus plans that sometimes companies have. Again, they may not know how much the bonus is going to be because it might be based on the annual net income, but they can estimate by charging the amount that they think it's going to be to expense, and then charging the other part to bonus payable, and then again it can be adjusted at the end of the year if those amounts turn out to not be exact. And then they give another example of companies that sell warranties and they don't know if they're going to actually have to deliver on those warranties. And I can let you read this for yourself, but it basically explains how to handle the warranty expense that is incurred, and then when somebody actually uses the warranty, how to go about recording that entry down here. And again, those estimated liabilities can carry over for more than a year. I mean, you might be selling a warranty that's good for 3 years, so you would put a portion of that in the current liability and you would put the rest of it in the long-term liability. That's all that paragraph is really talking about. One other type of liability that you may encounter is a contingent liability, which sounds a lot like estimated, but there's a little bit of difference here, because an estimated liability, you pretty much know that there's going to be some liability there, you just don't know the amount. A contingent liability is a potential obligation that depends on a future event arising from a past transaction or event. An example is a pending lawsuit, and this is probably the most common one, are pending lawsuits. When you're talking about a contingent liability, the question is, how do you handle it from an accounting standpoint? And that depends on how you interpret that particular situation. if you believe that there is going to be some liability, that it's probable that, yes, you are going to be required to pay damages based on this lawsuit. So if it's probable, and you can also estimate the amount that you're going to owe, then we are required as accountants to record that liability on our financial statements. The amount to be recorded as some type of a payable, because it's probably going to happen and we have a pretty good idea of how much it's going to cost us. However, if we do think this event is probable, but we can't in any way estimate what it's going to cost, we still put it on our financial statements, but we put it just as a disclosure in the notes. We don't record an amount for it. We don't put it on the balance sheet as a liability. We disclose it in the notes to let people know that this is out there and it could happen. If we only think that the liability is possible, but not probable, and obviously there's a matter of interpretation here, but if it's only possible but not probable, we disclose it in the notes, but we do not, again, record the liability. If we think that this possibility is only remote, we don't do anything. We don't have to put it in the notes. We don't have to record any type of liability. So they have some different descriptions here of what I just explained to you. Now, when it's a reasonably possible contingent liability, the reason why we have to disclose it is motivated by the principle in accounting called full disclosure principle. It requires us to disclose all information that might be relevant to decision makers that might be wanting to invest in your company. They need to know that a lawsuit might be out there that could end up really hurting the company. This is an example of a disclosure where Ford Motor Company says in their notes, they don't record a liability, but they say in their notes that various legal actions, governmental investigations, and proceedings and claims are pending arising out of alleged defects in our products. But in this case, they're assuming that, or that they can't estimate what that amount might be. Anyway, you can read the rest of this in terms of understanding the concept behind contingent liabilities. I will say that in most small businesses, you don't see stuff like this unless you know that that company has already been sued and that there is a pending lawsuit. This is much more common in very large corporations that have a lot of these kind of pending things going on that they have to deal with on a regular basis. Now, this just explains here that all of us face uncertainties about the future. Like there could be a hurricane in Florida that could cause major problems for your business. But we don't put these things on our financial statements because it's a future event that's not arising from a past transaction. So you don't have to disclose, we don't have to put on our financial statements, oh, we live in Florida and there's a good chance that there could be a hurricane here in the next 5 years, which could cost us X amount of dollars. It's a future event that's not arising from a past transaction, so it is not considered a contingent liability. All right, I would like to mention this section here that, again, talks about a ratio that can be used to help decision makers make good decisions about investing in a company. Most companies have some debt, and most of the time they're paying interest on that debt. And one of the ratios that we use to determine the health of a company is this thing called times interest earned, which takes your income, your net income before interest expense and income taxes, and divides it by your annual interest expense to come up with a ratio. And then you have to interpret that ratio to determine whether or not it shows the company to be in trouble or not. So in this particular example, there's a company called Diego, and this is what they actually did in 2013, but then they're trying to project for 2014. Their interest expense, this is in thousands of dollars, their interest expense is $60,000. And that's going to continue every year because they're paying on long-term debt that has an interest amount of $60,000 a year. Well, after what they made this year and their interest expense, they had net income of $90,000. Now, they're saying here, what happens if our sales increase by 50%? Our expenses stay at the same level, 75%. So in this case, we would have income of $225,000. The interest stays the same, so their net income is $165,000. But what happens if sales decrease by 50%? We still have $60,000 in interest expense. We still have 75% of our sales going for our expenses. So now we only have $15,000 in net income. Well, is this good or bad? Does this mean, if this were to happen, does this mean a person should really think twice about investing in this company? Well, let's look and see based on this ratio. If you take the figures from the chart up above, you would find that for 2013, Diego's times interest earned is computed as $150,000 divided by 60, which would be 2.5 times. So 150 divided by 60 gives you the 2.5 times. Experience shows that when times interest earned falls below 1.5 to 2.0, then the default rate on liabilities increases sharply. So if this number is 1.5 to 2.0, the company is considered to be risky to invest in because there's a good chance they're going to default on their liabilities. So if you were to calculate that for both of these possibilities, remember these are just projections, then I guess they're not showing that to us, but if you were to calculate it and take over here the income before interest and divide it by the interest, you would get 1.25. So if this scenario happens, you'd be at 1.25, which is obviously less than 1.5. So this company would then be considered to be at risk to default on their liabilities. Now, you might want to look at this particular example and then check the answer on page 402, but it gives you another example of calculating the times interest earned and giving you the opportunity to interpret whether or not company A or company B would be the better situation to invest in. But you may see this on your homework, so I wanted you to take a look at it as well. All right. Let me just see what they have here in the I just wanted to mention this particular appendix. I don't typically do this, but the Appendix 9A goes into much more detail about the different payroll reports and records and procedures that have to take place for an employer to take care of payroll. And this is true if you have 1 employee or 100,000 employees. All of these things have to be done, and besides the expense involved in the taxes that an employer has to pay, there's a lot of paperwork too, and there's a lot of deadlines involved in that paperwork. So you can get hit with some pretty severe penalties just for missing deadlines, even if you pay everything you're supposed to pay. So I'm not going to take the time to go through this whole thing because it's pretty detailed, but if you do have an interest in being a bookkeeper or eventually an accountant or have your own company, this is important stuff, and they do a pretty good job of summarizing it all. Appendix 9B talks about the income tax that a corporation could owe. That wasn't in the chapter. depending on the type of corporation you are, you may not actually have income tax on the corporation, and that was explained more in the earlier part of the book. But if you are a C Corp, a C corporation, you will have to pay income tax. And this just talks about the entries on how to do that. I mean, it's pretty simple. You basically, once you've calculated the amount of tax, you debit the expense account and you credit the liability account, the payable account, and then when you actually pay it, you debit the payable account and you credit cash. And this explains a little bit about that. It gets a little more complicated with deferred income tax liability. You can read this. It may be confusing, but I wouldn't worry about it. You would get into this more in an advanced accounting course. All right, that is Chapter 9.